Hello, everyone, and welcome to the Outspoken Market. Leandro Guerra speaking. Today's class it's about how to trade like a quant. And actually, I would like to share with you how I've been trading like a quant for the past 10 years and how can you achieve the same. Oh, Leandro, I'm not good in mathematics or programming. Oh, Leandro, I don't understand why somebody that claims to be successful in quantitative trading would be giving up something for free in a YouTube channel. That is the point, my friends. You are used to listen fantasies about retail trading and other things that are existing in the markets, then when not just me, there are other quants as well out there trying to teach you and explain you stuff, and then you simply don't trust them. But this has to be broken. We must stop it. We must stop thinking just about fantasies in retail trading and start having a systematic approach. So, how am I been doing this over the past 10 years and how can you start today doing so? Essentially, quantitative trading it's about following the scientific method. This is nothing new. This has been invented by a monk in the Middle Ages. So, I mean, there is nothing new on earth at this point in time. So, I've been trading the VIX, for example, the volatility index of the S&P 500, for the last 3 years and a half, more or less. Before that, I was trading the Great British Pound against the dollar, and even before that, the Euro USD par in the Forex. Currently, I also developed a systematic approach for trading options, especially when it comes to Bitcoin options. Now, all of this, regardless of the instrument or the asset that I've been trading, everything starts with the problem statement. First thing, you should never ever try to predict the prices. You don't do that. Don't. Simply don't. Oh, why? Why not? Trust me by now, don't. And the explanation, very short, is there are no mathematical properties in price series that would allow you to formulate a clear problem statement with some hypothesis that will lead you to something. Because all the methodologies that you are going to use to analyze the data and draw the conclusion, they will not apply to pricing. Oh, but I see many academic papers claiming that they can predict stock prices. That is why they are academic papers. So actually, they are more teaching you about a specific technique or approach rather than trying to really achieve an actual result. So fundamentally, trying to predict prices is wrong. But something that works pretty well is to try to understand what is the direction that the asset is going. What is the volatility? Even better, that one volatility that we can expect is something eventually mispriced, is something in the market that is being overreacting or underreacting. These are the type of problem statements that you should start with. So think with me, and by now you keep it like that. Or I will try to understand eventually the direction, or I will try to understand the volatility, and in both cases, I will try to understand whether the market is overreacting or underreacting to something. Because believe me, something is true. There are many brilliant folks out there trying to do the same. But the market is so big, it's so vast. There are so many ideas around to be tested that there is enough room, there is enough alpha, the edge that can be distributed for the ones that are trying to do the same thing. So starting with the state the problem. What is the point? So I want to understand, for example, if the volatility index eventually has a probability of going up in the next 5 days. Eventually, the opposite is true. So if it's not going up in the next 5 days, it's going down. Or I want to understand, now, the realized volatility for an asset, it's 20%. My model is telling me that eventually this can go up to 25%. And currently this is being traded in 19%. So there is an edge. I don't need to catch the entire 6 points of difference, but I can simply understand, yes, this is going up or this is going down. That's why direction and volatility are the best cases for you to start, especially volatility that is mean reversing. It's a process that will have its spikes, it will have its valleys, but overall it will come back to the long-term mean. So it's beautiful, it's very sweet trying predicting volatility. And I can show you a very clear example right now. So this is one of the models I have been working recently for the S&P 500. And as you can see, I'm predicting the volatility. So the realized volatility, so the one actually seen by the market, is the red line. And the one predicted by the model, it's the blue one. Oh, Leandro, I can see already, the model is bad because the lines are not matching. I don't care about lines matching. That is not the point. I don't need get to that level of precision. And if you think that quantitative trading is about that, it's wrong. It's not this what the concept actually is. My point is, you can see that my model followed and has anticipated the large chunks of movement in the volatility. And this is what matters, because I just need to be 50.1% or 50.1%, and depending on the decimal separator that you are used to have around the world, that I can be then profitable. And actually, this is a simple example. Another one that I can show you for sure is the following. It's the VIX. So this is live on the website om-qs.com, and this is updated daily. There is no human behind this. So you can come here and understand, look, this is the VIX, and this it's the capital curve, are the returns over the past 13 years. I'm not speaking about 13 days or 13 months. And this you can audit. If you don't trust me, just come here, take a look. The past results, they don't change. If you look, whenever you come in August 2019 and see that particular return in dollars, 9,000, and this, just be very specific. I'm trading $200 in that chart example without compounding, without augmenting the number of lots, the size of the position, nothing. It's simply linear. If that thing would be made exponential, well, I don't need to explain myself. But this is just for you to be able to audit it. Oh, why don't you show your true account? Do you want to pay my bills? Yes, then I can show you. Nobody should know anybody else's account or something like that. This is about privacy. But the point is, okay, so then how can I assure or really try to understand what Leandro is saying is true? Well, it's here. This is what I do, and this is what has been happening over the past years. So it's possible. It's entirely possible. Another example, it's about the Bitcoin options. This is for free. So every single day I give where the price of Bitcoin is going to be, considering the options expected movement. Oh, Leandro, so you are predicting the price? No, I'm not. I'm reading what the market, the dealers, the market makers are doing through the options positioning and running the calculations that will tell me the levels on which these participants are expected to do something, and we do the same. So you see, I have two different approaches that they were initially my problem statements. Okay, can I predict the volatility? Can I understand the direction? Yes. And then there is another problem. Well, can I understand the movement of the market makers and then eventually try to follow them? Yes, there are some ways of doing that. So, for example, I have a hypothesis. Um, do options allow me to understand what market makers are doing? This is a hypothesis. Predicting volatility with a particular type of model is possible, and especially understand if that volatility not in the two decimal precision level but the direction, is that possible to be predicted? Yes or no? Yes, I think we can, using a particular type of model like neural networks or gradient boosting machines. For example, don't worry about the names. Don't worry about the methodologies. This is something that we will extensively cover in the channel. What I want to show you is that I had a problem on which I was trying to understand if I can try to do something or not. Then, yes, I think I can, so I formulate my hypothesis. Then I have to design the experiment. Okay, how can I prove that my hypothesis can be accepted or eventually rejected? So, is possible to predict volatility? Yes. What do I need to predict volatility? Well, I need past data. I need eventually create attributes, meaning create additional data that eventually will help me to explain that particular phenomenon, and I will use a particular type of model. Well, volatility is a continuous number. So I will have to design my experiment in order to be able to deal with continuous numbers. So I need, for example, a regression type of model that is about continuous number. It's not a classification. I'm not trying to understand, yes, it's going to up or down or staying aside. I'm trying to understand if there is a continuous number that I can eventually track the direction later. Remember, I'm not worried about the number itself being extremely precise, but if I'm following the direction or not, even if I'm doing a regression. So I design my experiment, understand what do I need in order to try to understand if my hypotheses are going to hold true or not. Then I collected the data. Well, there is something that I really find very interesting, that it's the down theory. And the down theory states that every information that exists in the market, it's already included into the price. Of course, there might be insider information. Yes, but let this to the insiders. That might be even illegal in several cases, and we don't want to touch that. But around all the information that is public, and in the era that we live, that everything is extremely fast, everything is already in the price. Okay, wonderful. So how can I try to understand that? Well, first thing is understand that price moves with time. So I need the historical data from that price. Price varies along the day, so I need the information like the open, the high, and the low of the day, and where it has closed. And this is the final price for the day. Then I started doing comparisons. How the close of today compared to the closes of the last 5 days. How the opening is far from the opening of the week. How the opening of Friday is far from the high of Monday. So there will be several attributes that with the data that you have collected must be analyzed. And then by analyzing this data, you then run a model. That it's going to be our next class. Why I should care about mathematical models and how on earth can I develop them. And there is always the point. Leandro, I'm not good at at mathematics or programming, as you said in the beginning, that eventually is required to become a quant. But, as I said as well, there are other things that you can follow. And what you should follow if you're not into mathematics or programming, it's the quantitative approach. It's not technical analysis, it's not chart analysis. Have you ever seen a hedge fund, BlackRock, Vanguard, you name it, saying that, well, I will allocate a huge portion of my portfolio because I saw in the chart that we have that trend line going down, and this, well, allows me to allocate $10 billion in that particular stock. I mean, you must be kidding, right? If somebody thinks that this is something serious, honestly speaking, I mean, it's not. And then you draw the conclusions. So, okay, I will then evaluate my model and understand if everything that I said throughout the process was true or not. And I like very much that particular diagram of the scientific method because you can see that it's almost like a loop. My conclusions, they are not written in stone. They are not eternal. Any point in time, I can come back, review the problem statement, or think about a new problem statement, and start over. That is why it's a job. It requires time. There is, aside the Federal Reserve and the central banks, there is no money printing machine. Everything requires hard work. And that is the point. And this is why, why we win by being quants. Do we win because we have an edge in the market? Yes. But there are so many doing that. That is the point. There are not that many as you think because this is hard work. And people, they are not much into hard work. Yeah, they are lazy. On average, people are lazy. So if you just keep, on average, having the edge over the market, and that means that you don't need to be right all the time, but you must be right in a way that your expected value is bigger than zero, meaning that you have an edge, and then when we win, or when you win more on average than when you lose, you are fine. You just need to let the time pass by and you are going to collect your profits. It's as simple as that. How to trade like a quant. There are, of course, the methodologies, but if you get the principles of everything that I described and taught you in today's class, you can get to wonderful places. For example, with the options analysis that we have seen, take a look at the time this has been posted. 5:47 a.m. GMT. And here we said, through the data, that look, there is a call wall in the options in 102. Leandro, I have no idea what a call wall is. Don't worry about that. Follow the newsletter. There are several explanations and there are previous videos in the channel Outspoken Market Global as well. We have seen that there is a wall in 102 for 1 day to expiration, meaning that today is November the 5th. For November the 6th, we have that expected value as a resistance. Aha! Then when we drill this line in the chart, well, now it's almost midday. Take a look how many times we have touched that particular line, and we are bouncing back because call walls are resistances. And how do you trade? Well, here I open a short position because it's more likely, it's not guaranteed, it's more likely that the price will resist at this level and will bounce back. And by bouncing back, if you have opened a short position, you profit. If you buy a put option, you profit. There is another wall there in 100K. So eventually, as it has done yesterday, the price will bounce back again. But this is also as glass. The more you hit, the more sensible it gets. Eventually, the lines will be broken. And when they are broken, you know where the next levels are. This was done using the quantitative approach, using the scientific method. Is the same, for example, when we are trading the VIX. So quite simple, we understand when we should go long, when we should stay away from the market. And whenever we go long, eventually we'll be at a higher price. And here in particular, that model, my target or the assumption I did when I was running through the scientific method, it was, can I predict and understand the possible direction of the VIX for the next 5 days? How I would do that? And then whenever, and I have drew my conclusions, the chart it's there to prove itself on a daily basis, then whenever the model tells me that I should go long, I go long and hold the position for 5 days. And this is what you can see here. So eventually that one on the 22nd of October 1929, we have opened a long position. Then 1, 2, 3, 4, 5. Well, that was a little bit of a loss. But we had, taking looking, well, in the back history, several ones that they were long and we were selling way higher again. And that's why the curve starts to go up. And then the last thing before we close the class, understand that drawdowns are part of the game. You are not going to be right 100% of the time. But if you keep yourself in the game long enough, well, you can collect profits. Remember, this is with a $200, position size only. And in the last 2 years and a half, we got from 10,600 up to 12,600. So we are speaking about a $2,000 gain, already discounting the operational costs. This is really important. It means 10 times the size of the account. If you had 1,000, you would have 10,000. If you have 200, you would have 2,000, and so on. It's as simple as doing the math. Okay, folks, so any questions you have, leave your comment over here. I will be always available to answer you. Subscribe to the channel, clicking the like button, and see you next time. Take care. Bye bye.